I'd like to welcome everyone to today's webinar. My name is Rob Barnett from Bloomberg Intelligence, and we're really pleased to have partnered with the fantastic research team at Cowen for a wide-ranging discussion on ESG and the energy transition. In many ways, we're in unprecedented times in energy markets right now. Oil, natural gas, coal, you name it, they're all elevated, and the daily and weekly volatility is mind-boggling at times, and arguably we're in the midst of a huge supply shock. And now we've got this new paradigm to layer on top of that of ESG, reducing emissions, broadly this idea of the energy transition. So in the run-up to this event, had a nice conversation with Lisa Thomas, Associate Director of Research at Cowen, and she talked about the history of oil and gas that the company has had, and really an understanding and coverage of the traditional side of the business, and the recent pivot to cover some of these really new and interesting topics. So I think you've come to the right place if you want to have a conversation on where we've been, where we are today, and where we're going. So without further ado, let me introduce the panel. We have David Deckelbaum from Cowen. He's the Managing Director of Sustainability and Energy Transition and has a very interesting and wide coverage portfolio. We've got John Miller, also from Cowen, a Director of ESG Sustainability and Policy. And last but not least, from the sister part of the organization, BloombergNEF. If you don't know them and you're thinking about the energy transition, I encourage you to check them out. David Hostert is our global head of economics and modeling. So I think we've got a really good set of speakers who can help us sort through all kinds of things related to the energy transition here. And I think when many people talk about the energy transition, there's all this discussion about 2050 net zero. And frankly, 2050 is interesting, but it's really outside of the time horizon for in scope for most investors. So if you look at the near term, let's say near term is 5 to 10 years. I want to come to you, David Deckelbaum, first and get your sense. What are we going to be surprised by in the next 5 to 10 years when you think about the energy transition? What are the hot aspects of this broader question?
It's an interesting one to think about because I feel like we've already been significantly surprised in the last 12 months. So energy transition, I think, has not been a relatively new concept, but COVID obviously accelerated, I think, a lot of global ambitions. I think immediately what the world was surprised around was just the penetration around electric vehicles, and not just the desire for consumers, but the hundreds of billions of dollars that have already been committed by OEMs outside of China to begin shifting their portfolios to predominantly electric vehicles. And I think we're right now in the crosshairs of dealing with this supply chain management issue and, really looking at how difficult it is to kind of turn a barge on a dime the way that we are. So I think when you lay out 2050, I know that it's really far away, but I think practically speaking, you can't upend humanity overnight. So yeah, I think that we're going to be surprised that, like, in the next 5 to 10 years, the policies are all in place, at least around electrification, around transport, and the motivations are there. And I think that the surprises, I think, are going to be how in the world is, like, the auto industry going to keep up with these deliveries? And then if they don't, how does the industry pivot and how does the world pivot? Because I think, I look at that as microcosmic of so many of the issues that we see today where the supply chain is disrupted. You look at electricity prices in Europe, and all of a sudden German coal-fired plants are back online. Obviously, there's a war overlay in there, but I think it is illustrative of how difficult it is to troubleshoot for one variable and another variable pops up there. So I certainly think, like, OEM deliveries of EVs perhaps missing their mark and needing to pivot around some other technologies. I think that's going to be a very interesting surprise in the next 5 years or so.
And what's your sense? I mean, are we getting close to the point where EVs have a noticeable, meaningful impact on oil demand, or is that something that's much more long dated?
EVs do not have a noticeable impact on oil demand. I think like if you bifurcate transportation demand of oil, it's not the majority of the demand globally. And then certainly light vehicles versus heavy vehicles and commercial applications. And jet fuel, obviously, those are elements that are never going to change. So changing like a subsegment right now where, you're looking at globally EV penetration rates of new vehicle sales in the 10 to 12% range, looking to triple that, in the next 8 years. Even by then, we had done some work earlier in the year that you're really only disrupting maybe 4 to 5% of long-term oil demand. And because oil demand still grows with population growth over time, you're slowing the pace, certainly, of oil demand growth and perhaps flatlining it. But I think that demand destruction isn't so palpable that you're seeing oil demand dropping off a cliff just because of EVs.
Well, the environmentalists might be disappointed with that answer, although I think we kind of see it pretty similarly. John Miller, let's come to you. I know you kind of look at this with a little bit different lens. What do you think is going to be very meaningful over the next 5 to 10 years? And maybe a bit of a loaded question, but in the U.S., I know there's a lot of discussion about decarbonizing the grid by 2035, perhaps in support of the rise of EVs. So, is that doable? And what are you really looking at here in the near term?
Yeah, sure. So 2035 net zero greenhouse gas emissions on the U.S. power grid is a Biden administration target. That's been a target that he's pushed forward really since before he was even the candidate for the president for the Democratic Party back in 2018, 2019. So, our approach is a little different. So I sit within a research pod that specifically looks at policy, so legislation and regulatory actions. And my coverage is really around policies that will affect the ESG narrative. So kind of what is that? And you mentioned at the beginning, there's these long-term 2030, 2040, 2050 targets. There's sort of expectations for certain sectors of the economy to follow pathways that achieve a 2 degree or a 1.5 or a post 2 degree world during those periods. So we try and isolate, identify meaningful actions, and then try and just game out where are they in that pathway? Are they likely? Are they unlikely? So, I like to approach this from the fact that energy is a system, right? Major changes require long-term consistent planning, and that's 10 or 15 years plus. So from a policy perspective, there needs to be a long-term outlook. And we're now, unfortunately, in an environment where policymakers are looking for short-term levers to pull to fix big macro problems, and they just don't exist. And that's where Joe Biden is now. He is, again, campaigned on this position of 2035 electric power system that has zero emissions, longer-term 2030 a 50% reduction, 2050 target for zero emissions. And now he's out there, we're selling 1 million barrels per day from the Strategic Petroleum Reserve, and he's asking for a gas tax holiday. And so the message is really, really unclear. I think in the next 3 to 5, 10-year period, it's really unclear, right? We don't know. We have a lot of policy flip-flop in the U.S. Biden administration came in, overturned a lot of rules from the Trump administration. Biden administration is now writing a lot of rules on the EV sector, specifically looking at tailpipe emissions. They'll be looking at greenhouse gas emissions from power plants probably in the beginning half of 2023. But 2024 is going to decide, right? The next administration could come in, could be a Republican administration, and we could go back to zero on that. So what we're left with is just sort of a long-term grind here in the U.S. where, based on economics, based on some state-level actions, the penetration level of renewable power systems in the grid continues on a yearly basis. The penetration of EVs continues on a yearly basis, but there's no upward inflection. So I always point back to that annual grind we've really seen going back to really 2010.
Thank you, John. Okay, David Hostert, you run the long-term scenarios, the new energy outlook for BloombergNEF. What do you think? Is this a slow grind, or are we going to be surprised by some of the things that could unfold over the next 5 to 10 years?
Yeah, no, it's taking, but by what John said previously about the role of policy, because that's something we're trying to abstract from when we do our modeling. So our modeling is a economics-led scenario that says what happens if you let the current policies run, policies that are well funded, like the PTS in the US, and then the PTC in the US, and then you kind of take the hand of the tiller and let the economics run and see what happens. And what happens is actually a lot. We find that the kind of based on the work that we're doing on EVs, on EV uptake, and as David said, we're now in the steep part of the S-curve, right? We're now in the kind of consumer segment where consumer choices rapidly accelerate the deployment of EVs, but also 2- and 3-wheelers, which is a massive segment in Asia that we don't kind of often think about when we think about EVs. What it does, though, is that that in the next 5 to 10 years, you end up with systems where renewables continue to push, where EVs continue to push, but you don't get to net zero. Like we know that, right? Even if you kind of take an optimistic view on future cost deployments, then we're not going to get easily to those targets, and that's where it becomes, the whole discussion about net zero becomes interesting. What do you need to kind of flex and do? And I think what I find consistently surprising is regardless of the scenarios that we run, if you look at the next 5-7 years, based on the existing technologies that we have, to wind, solar, battery, we get to similar results. It's only then that we need to think about this next level of technologies, the kind of tier 2 technologies. And Rob and I, we talked about hydrogen, we talked about CCS, we talked about even small modular nuclear reactors. So I think the challenge is you need to stay the course, accelerate what we have, and then make decisions today about what will be the next level. Because to get there, we have these incredibly long lead times. You can't just decide something today and then expect it to happen. If you want to have new offshore wind targets in the 2030s, those concessions need to be going out now, because you have 8 to 9 years lead on an offshore wind project. And I think that's the challenge at the moment. Stay the course, make sure you don't kind of take the hand off the button, and at the same time start making decisions and investments into the next tier, which is by all intents and purposes, if you look at this year, is around the corner. I don't know where your 22 went, but mine went incredibly fast.
You still got 6 months left. Okay, David Deckelbaum, we're going to come back to you. What do you make of the idea of constraints? So, if you laid out a vision for what could happen in the EV space and the ramp that's occurring there. Is lithium the biggest constraint? Is EV charging the biggest constraint? What are the hurdles that either sort of allow the vision to unfold or hold it back a little bit?
Yeah, that's it. It's sort of a multivariable calculus problem. So lithium is a constraint, and I think it is one of the primary limiting constraints because it's ubiquitous in all battery chemistries right now. Interestingly, I think, again, John was alluding to or discussing policymakers looking for very short-term solutions. Automakers are looking for solutions where they're looking for substitutes. How do you get lithium ion out of the battery? How do you rely on more readily available materials? But these are, those are sort of like venture capital type moonshots that might never materialize. Instead of looking at more practical solutions of how do you bring on some of these critical materials and how do you partner with some of these miners. And I think one of the issues that we find, at least around battery related materials like lithium, is new supply can often take, even for a brownfield project, 4 years. A greenfield project might be 7 to 10 years. And then keeping in mind, this was like a small cottage industry a couple of years ago, and now you're asking, at least for lithium by reference, to grow on order of 8x by 2030. Where if you look at the number of incumbent producers, you're really looking at only 3 or 4 significant ones, and then maybe a dozen in total that would really amalgamate up to what global supply looks like. And now you see dozens of new entrants in, an extremely difficult operating industry, trying to answer industry's call and demand. So that's but one constraint. And then certainly you have, depending on the battery chemistries that are out there, issues around nickel and graphite, and certainly cobalt and manganese, and even things like phosphor in your LFP cathodes. So there's a whole host of constraints, and I think, but what's interesting now is you're seeing not so much the fact that people can't get their hands on materials. I think even Tesla, Elon Musk discussed the other day that his plants in Germany and otherwise are losing money right now, and a lot of that's just because they can't get their hands on enough machinery around manufacturing. So there's just so many constraints there that to point out one I think is difficult, but I think at least if you were to try to make a recipe for an EV, you need lithium above all other things.
Let me test you on the idea of ESG and mining. So you mentioned a whole series of materials that are critical, and a lot of the mining companies might have coal in their portfolio. They might be very complex entities, and so do you think there are ESG investors who can get comfortable with the idea that some of these mining companies are providing critical elements and are actually part of this big energy transition narrative, even if they may have things to manage? How do you think about that?
I do. I think that ESG is very iterative, and I think the investor focus. I don't think they can be completely agnostic to returns. So I think that there are times where you're seeing right now where the S becomes more important than the E, and I think that there is perhaps not a universal buy-in around mining for critical materials, but I think there's very much a recognition that it's part of the ecosystem that I need to capitalize if I want to see the world electrifying. But I also think on top of that, there's a view, just like there is like with fossil fuels, there is an ideal way or an optimal way to produce fossil fuels, and there's a suboptimal way. There is an optimal way to mine for lithium, and there is a suboptimal way. And I think if you don't invest in the supply chain, particularly in the Western world, you will end up with a host of suboptimal sources of supply. And I think that's the lens I think that ESG investors are starting to look at, because I think you're also finding fossil fuel companies ending up in ESG portfolios for those reasons.
Very interesting. John, I want to circle around to you and gauge your sense of the discussion, particularly in D.C., around the energy security component and sort of where the resources sit. Are there concerns that we're going to end up in a world where a massive part of, say, the analog is a huge part of the solar supply chain is in China? Are we going to end up in a similar world where huge parts of the EV and other energy transition supply components are not in the U.S.? And what are they thinking about, onshoring both resources or the manufacturing piece of it?
Yeah, that's a great question. And maybe just 1 second on the last comment on ESG. So ESG, first and foremost, is an investment framework. So returns come first. There's always going to be a huge spectrum of approaches in this space. So, your retail-focused ESG ETF, right, that's using a rating score at the top, it's going to struggle to integrate these names that are more upstream. Your more advanced, actively managed fund that's integrating ESG in a holistic perspective, right, is looking at megatrends, and I think that's going to be a great place. The conversation to energy security, yeah, that's basically what happened, right? So last October, November, there were a lot of tailwinds behind the climate change story here in the U.S. and in D.C., right? Just passed the bipartisan infrastructure law, or the Infrastructure Investment and Jobs Act, whatever you want to call it. Over $500 billion in new spending in traditional infrastructure, but a lot of that went towards carbon management, electric vehicles, things of that nature. And then there was the COP26, right? And the U.S. we're back in the story, we're there, we're re-engaging. Almost immediately after that, we began to see inflation kick in fossil fuel commodities, right? And in the U.S., it's all about gasoline prices. In the U.S., almost every corner, there's a gasoline station that has in big letters the price, and you can see that every single day, and you see it going higher. And then polls effectively for politicians go in an inverse direction if they're in power. So energy security became the conversation. There was this period of time in November and December, and I freely admit that I was caught up in it, that there was an expectation and possibly a hope that there could be some sort of bipartisan compromise on how we integrate the concepts of an energy transition with energy security. Exactly the points you're making, Rob. Like, how do we in the U.S., in Europe, and other countries continue some of the trends that we've already seen in COVID, right? Instead of having a globalization, a global system, we have regional trading partners, we have security of supply through different assets that are some in North America, some in South America, not just in China and Asia. And so where we are right now in the U.S., 80% plus of panels are coming in from Southeast Asia. There is an ongoing trade argument that those panels are actually manufactured in China and just wheeled through third-party countries. And so the president had a sort of whack-a-mole that situation with a waiver on that. We're seeing that emerge in the EV value chain as well. So there's two parallel policy objectives here really from the Biden administration, and they're in conflict. One is an accelerated renewable transition, right? Get all those solar panels on the grid, get 50% of new sales for light-duty vehicles as EVs, and parallel process, do that all at home. And when we've seen this administration really stumble, it's been when they try and do those two things at once, because they can't be done at once, right? The time frame to get the U.S. capacity in place here is going to take time. David just mentioned how long it takes to get a mine on. It's faster to bring a facility on to build batteries, to build cars, build panels, but it still takes 2, 3, 4 years plus. So where we are is in a real push by the administration to get a range of advanced manufacturing credits, and nearly $4 billion in advanced manufacturing credits, both an investment tax credit and a production tax credit for the production of solar panels, wind infrastructure, and around semiconductors. And so that's the push. It has to go through Congress, and it's going to be a challenge. The other side of this is sort of the traditional Republican argument that we just need to produce more fossil fuels here in the U.S. And there's some to that. We've seen production dip, obviously, through 2020. There was a large pullback. Capital has been moving out of the space. ESG investors have put a lot of pressure on these names, and the sort of 5-year track record of E&Ps in the U.S. has been pretty unattractive in general. So there is this back and forth here, and it's unclear how it's going to play out. The administration is very supportive of delivering hydrocarbons to our allies, specifically LNG, but they're not supportive of midstream infrastructure. So again, there's this binary going on where we're kind of, again, caught in a grind. And I don't want to go back to the language, but it feels like we're just grinding it out.
Very interesting. Okay, just a quick advert here. In the lower right-hand corner of the screen, there is a chat box where you can type in a question. If you do, we'll try to field it during the discussion here. So feel free to weigh in for anyone that's listening. I know you probably have questions. If you don't, I'll just ask them all. But David Hostert, I want to come to you on this issue of supply chain and how things are playing out. One of the most famous charts, I think, in the energy transition, and I will give BloombergNEF credit for this, is this long-term trend for solar. It's just coming down. Wind, same kind of thing. Batteries, we see a similar curve. They've gotten a lot cheaper over the last decade, which is really part of the reason I think they've expanded. You talked about your economic modeling framework. Although here, in the last 12, 18 months, we're actually seeing solar panels cost more. We're seeing wind turbines cost more. Do you see these issues being sorted out anytime in the next few years? Are we going to be in sort of this constrained market for a little while, and how's that going to affect demand for some of these clean energy technologies?
Yeah, excellent question. I think just zooming out, if I think about my time, like 12 or so years in the energy transition, the debate has always shifted between kind of what energy system do we want to have. It needs to be reliable, it needs to be affordable, it needs to be green, we want it to be green. And the debate has kind of shifted around these with the addition of green jobs, which has been a big push, and then energy security, which has been a big push. One of my first roles at BloombergNEF was looking at biofuels, and we had a lot of discussions with the Army, U.S. Army and Navy about how they could become more independent using biofuels. So it feels like in a way we've gone a little bit full circle. We're going around in circles on these issues, and right now the issue is energy security and affordability, because we're all feeling the pinch in terms of energy cost. For the supply chain, it's true that the kind of overall, put another way, the factors that might drive a recession, that might drive a economic downturn are, in our view, actually not affecting the energy transition sectors we care about. What they do get affected, though, by the underlying problems in the economy that lead to a kind of recessionary feel. So it's everything to do with disrupted supply chains, with things being in the wrong place simply. The crude oil is in the wrong place. There is enough gasoline globally to supply, elevate the pressure on U.S. consumers, but it's not getting there because it's not being traded. And then we have kind of misalignment, labor cost hikes, and trade barriers, which have, in various phases are becoming an issue again. So all these factors put pressure on renewables. But when you then look at the country story, it's a very varied picture. And we're actually about to publish next week our LCOE update. And some of it, what it shows that, yes, costs have gone up in specific sectors, but the picture is uneven globally. Like the costs for wind turbines in China have gone down. Based on market dynamics, and China is half of everything in the energy transition. So once you start looking at the global level, then the costs actually have plateaued a little bit. When you zoom in, then you'll see that the delays in shipping and delays in project as well are weighing. So project developers are waiting longer and longer to kind of order, which in turn puts pressure on turbine makers, puts pressure on their margins and the way that they're hedging. So do we think these are structural issues? If you look at module prices have actually not increased and are not, like in the last half year, and are plateauing, and we fundamentally don't believe there's a long-term shortage of any of the critical materials. David, you mentioned at the top of the call, when you talked about battery chemistry, how quickly it's changing. I just quickly looked back at our own electric vehicle outlook, comparing what we said in 2019 and 2022 for cobalt, and we cut that by half. So the outlook that what we think we need for cobalt for batteries in electric vehicles by 2030 is 50% less today than it was in 2019, when we were forecasting less vehicles as well. So the battery chemistry is shifting very quickly, but there still needs to be a lot of investment in supply chain, and there are going to be short-term bottlenecks. But overall, we think that most of these are kind of hiccups that will last, 1, 2, 3 years, but fundamentally are not a hindrance. We're not fundamentally short on any of these, and there's enough innovation to move away. But there's this kind of grinding, I think, is exactly the right word. It's a kind of slow restart, and a good title for the global economy at this point would be, have you tried turning it on and off again? Because that would really help.
Thank you, David. Okay, David Deckelbaum, I want to come back to you on an interesting idea that I believe you've considered. So utilities have been this generally sleepy sector over the long arc of history, quintessential grandmother stocks, or however you want to think of them. But the energy transition has completely changed what their opportunity might look like. And so the EV narrative could potentially boost demand for electric power, probably a good thing for utilities. And I also am curious to get your sense of, we talked a lot about lithium and batteries. What's your sense of batteries going onto the electric grid to get paired with renewables? So set aside the EV side of it, are we also going to see pressure for those same materials as more and more utilities try to balance the intermittency of the increasing renewable penetration?
Yeah, so I think immediately that's obviously an energy storage question, and I think interestingly you've seen it probably gets commonly overlooked, but Texas is one of the largest energy storage markets in the world. And a lot of the prevailing technology there is lithium ion, but I'd say because energy storage in general can be more agnostic around battery chemistry, it's not as sensitive per se around things like density. It has to deal much more with heat and really the duration of the battery life. So I think there's other competing technologies out there that would not necessarily rely on lithium. I think lithium obviously has a growth opportunity with energy storage, but I think logically energy storage is a very real and practical answer, particularly in areas that have available land space to combine with the utility side. And I think it makes everybody obviously a lot more efficient. And you already see those applications obviously in areas like Texas, where you've seen several megawatt installations that are out there that obviously are heavily reliant on lithium for now. But I think that's probably an industry where you see the fastest sort of substitutes coming from areas like zinc bromide flow batteries or vanadium flow batteries or other flow batteries that again could be theoretically as large as they needed to be. And you run into more issues in some regions where there is more intermittency around electrical demand or electrical supply rather, but you have temperature considerations. Lithium doesn't do particularly well in heat. It's highly flammable. That's why you see the headlines of electric vehicles that continue to burn forever. So it's a consideration, but I think again, like energy storage has to be a critical, and it's a relatively easy solution. There just needs to be some capital behind it. Yeah.
Very interesting. We've got several questions that have come to me through the chat that ask about nuclear. And so what I'd pose to the group here then is, we just kind of walk through, what role could storage play? But in some sense, if you have we know wind and solar are intermittent. It's sort of an obvious thing to point out. And we know that there has to be some type of what we've traditionally called baseload. And there are so many ways you could think about baseload, but nuclear, carbon capture and storage, maybe some kind of, hydrogen that's run through a CCGT. There's so many novel ideas that folks are discussing. John, we'll come to you first. What's your sense on that discussion of, we know we can get only so far with renewables. What do the renewables get paired with?
Yeah. I'm trying to streamline some thoughts here because I'm looking at the chat box too, and I really like the questions that are coming in. I think the first point would be there's a number of studies came out last year, Department of Energy here in the U.S. Sort of leading the way, and their argument was that with solar, wind to a smaller extent, paired with existing 2 to 4 hour energy storage, by 2040, the U.S. can be 80 to 90% emissions free on the grid. So these are commercial technologies in place, and we should really be focusing on just getting that done. I understand there's a venture community, there's a place for government around R&D for these emerging technologies, but it's not really a technology question anymore or a reliability function anymore. It's just a focus question. Can we focus on getting that 80 to 90% done, really tackling climate change, if that's the objective? Once that's done, then you can really begin to think about all these other different products. And one of the questions I see in the chat box that I really like too as well is around infrastructure. So I attended an energy storage day yesterday, and it wasn't about chemistry. It wasn't about the different technologies. Everyone was asking about interconnection and then transmission, right? Because in the U.S., that's the problem. Texas is awesome. There's 5-minute market prices there. They're extremely volatile. There's no capacity market, so it's all in energy and ancillary services. So batteries want to be there. The problem, batteries can't connect right now. They're running into those problems. In other markets in the U.S., most of the fixed cost is covered by a capacity payment, and batteries get a significant haircut. So there's all these little things around the issues of, I think that whatever the technology is, it will need to connect to the electric power system. And so transmission and the interconnection are the places that need to be focused on. There were some updates to that in the bipartisan infrastructure law. The Federal Energy Regulatory Commission now has what's called backstop authority to basically, if a state is blocking a transmission project that's deemed critical in some way, the U.S. government can sort of step in and say, no, this project needs to go ahead. And we've seen California in the past block a lot of projects that were inbound into the state, which seems nuts, right? California is constantly running into challenges in the summertime, and it needs to import as much power as possible. So I mean, that's worth watching. Nuclear will work out if the costs are there and the public policy is in the right place, right? We've seen these declines in solar and wind and storage. The sort of advanced reactor prices are kind of fixed where they were 5 years ago, 10 years ago. That needs to change. And I think all the investor-owned utilities are kind of watching to see if these projects can play out. No one wants to be first. So in the U.S., the last major build was Southern's project at the plant Vogtle, and that's years over budget, years past delivery time. And so there's a lot of hesitancy there. That needs to sort itself out before that becomes really economic and efficient in the marketplace.
Very interesting. I'll just point out on the question of nuclear, there's a NuScale, which is a SMR company. one of your colleagues is the lone analyst on the street covering the name. He's going to be joining us for a future conversation, but the ticker is SMR. Hats off to them for getting a great ticker there. But David Hostert, you've kind of heard some of these ideas that John was just walking through. So I want to get your sense, what are the portfolio of technologies? And I want to ask you about market design as well, because it seems like there has to be policies to really, facilitate some of these things happening. So what do you make of the technology portfolio, and what kinds of policies are needed that aren't there today?
Yeah, finally I jotted down market design in big letters on my pad here as John was speaking. I think that's absolutely right. I think, 100% agree that transmission infrastructure is a key bottleneck in many countries, especially in the US. You mentioned also kind of energy-only markets versus capacity markets. We've seen a big crisis of three of the most prominent energy-only markets. We've seen that big Texas freeze in 2020 when prices went through the roof. We've seen mass failure of suppliers in the UK when prices moved. And now last week, the Australian energy only market was suspended because they couldn't sell us anymore. So there's some... this is not to say that energy markets don't work. It's just saying that is a big challenge to sort out, because if we get to a system where variable renewables, in one form or another, contribute the majority of energy to the grid, then we need to find a way to have a market design that works for that. And again, it comes back to what I said about reliable, green, affordable, balancing those key kind of targets, and they inherently in conflict. Green and affordable, energy security as well. So that's a challenge. On the regulatory side, the thing that is tricky when you think about SMRs, for example, is the whole issue around certification, around getting approvals, because you said, Rob, we need some kind of baseload. I would actually contest that. In the sense that we need dispatchable generation, but it doesn't need to be the kind of gigawatt scale nuclear baseload that we may be thinking of right now. So if you think about a 3, 4, 5, 6 gigawatt nuclear plant, that's a huge point of failure. We had an interesting situation in the UK market in the summer of 2020 where the regulator asked paid a nuclear plant to shut down because it was more expensive to have that plant run and then have 9 small plants prop it up in case it fails. So you're running an incredibly low system, and suddenly having these huge points of failure becomes an issue because you need to back them up, and somebody needs to back them up. So in that sense, the promise of SMRs is that they're smaller, 250, 350 megawatt size. You can put them where gas plants were before. That gets around some of the infrastructure problem because you don't need to put in new connectors. You can use the existing infrastructure. But there are some real challenges. The US, interesting enough, has hedged its bet a little bit across all of these. So it's both talking about SMRs in a small way, but also about gas plus CCS. There's a huge kind of industry experience with CCS. And it's talking about hydrogen, green hydrogen in particular. So you can see how countries are hedging their bets, but to John's point, they need to make a decision and then walk that way, because 2030 is really around the corner.
Well, you convinced me. I guess I'm old school. I'm going to stop using the term baseload, and I'm going to move to dispatchable power from here on out. I like the idea that you should be thinking about it more flexibly. That makes a lot of sense, and I 100% agree with this idea that, if you have one big asset that is baseload, it's probably very difficult to manage. That is very intuitive. Now, we've had a pretty interesting discussion, really kind of focused on a little bit of EVs and the electricity side of the equation. We'll shift gears with some of our remaining time and think about some of the harder to abate sectors, as they're often called. We haven't talked about heavy-duty trucking, shipping, aviation, these kinds of things. So, David Deckelbaum, I'm going to come to you first. You seem quite optimistic about the role that EVs can play in the light-duty side of the equation. What about medium-duty, heavy-duty as a starting point? Are we going to see batteries play a role there, or is it going to be some other fuel or technology?
I think that for the time being, light-duty vehicles are going to command most of the battery demand, at least on the material side. And I think that probably makes the most sense. Heavy-duty vehicles can rely on alternative fuels, particularly applications like hydrogen fuel cells, and some other applications where you can perhaps deal more sensitively with hard to consume materials and hard to consume substances. So I think that there's a more logical application there for hydrogen and the like. But I don't necessarily think that putting in 300-400 kilowatt-hour battery packs and tractor trailers is going to be the best use of the precious amount of materials that we have out there.
John, do you think policymakers in DC kind of appreciate the relative order of maybe where certain materials should be going, right? Because I think the argument here is you probably get more bang for your buck in light duty. So when you think about some of these other sectors, is the right answer for a policymaker to sort of be agnostic and maybe pause on them? Or so what should the approach be to heavy duty or something that's more challenging?
I'm sorry. I'm sort of chuckling at the concept of a policymaker pausing. That's just like not what it's in their DNA to do, right? It's to just constantly be just producing, right? So again, this is a much smaller part of the U.S. emissions footprint. I think the focus, again, really should be on decarbonizing the grid, light-duty vehicles. The solutions are there, but that's not to be said that there isn't focus and attention being put on these other aspects as well. So for heavy-duty trucks, heavy-duty and medium-duty trucks, the EPA has this clean trucks plan. So that's a 3-part rulemaking that's going to be coming out over the next 18 months. It's much more agnostic around what the technology is going to be. For emissions intensities and tailpipe emissions from light-duty vehicles, the EPA has been much more strict in its language that we are getting a place toward, we want to move towards vehicle electrification by 2030. They're going to use tailpipe regulations to move towards electrification. When it comes to heavy-duty and medium-duty vehicles, it's much more wide open, right? So there's a conversation for fuel cells in there, there's conversation for hydrogen, there's conversation for other areas. I think where there's interesting attention too is on fleet vehicles, so like that sort of last mile delivery. These are great to electrify. They start in the same location every day, they end at the same location every day, and in the case of the United States Postal Service, they drive the same route every day. So there's ongoing litigation here in the U.S. about the United States Postal Service not moving faster to electric vehicles when they had the opportunity. There was a carve-out in the Build Back Better Act, which is the Biden administration's long-term climate spending and social spending, that provide a new investment tax credit for fleet vehicles. So if you are a fleet buyer and you bought a truly electric vehicle, you get a 30% investment tax credit. If you bought a plug-in hybrid or some sort of hybrid vehicle, you got a 15%. So I think that those things are moving forward and the conversation is there. It's just, I think a point from David H. earlier about cost, right? This has to be cost effective. For all these businesses, fuel is really their key cost, right? Is this business going to be profitable or not? So there's a lot of attention being focused on that. And how do we change that construct, right? Are we thinking about just immediate short-term costs, or are we thinking about the externalities of those costs? So when the EPA is creating a rule and they're looking at the net benefits, they're considering greenhouse gas emissions times the social cost of carbon. Now, if I'm a fleet vehicle operator, I don't consider those things at all. So that conversation really needs to be squared before we can move forward in a big way.
What's your sense on Build Back Better, by the way? Is that really something that's still part of the mix? Could we see it move forward? One of the regular questions I get inbound to me is, hey, is this thing alive or not? And you're closer to the where the sausage is made. So what's your take?
I mean, it's alive until it's not, right? So reconciliation is tied to the budget, the U.S. government's fiscal year, budget year, and September 30th. So it's not dead until September 30th. Our perspective is that we have as low conviction as possible, but it's still out there, right? Key members are still meeting, they're still discussing. We think August 4th, 5th, which is the dates before the August recess, are really critical for action. So, worst case scenario, you just have to look for 2 more months, right? It's not an 18-month thing, it's just a 2-month thing going forward, but it still needs to be out there and needs to be on your radar. If you're just counting to zero, we think that's kind of inappropriate at this point.
Assuming there's a change of power in the House in the upcoming midterm election, does all of this stuff go off the table, or could you still see some kind of policy energy discussion if the Republican Party takes the House?
Yeah, it can go in two ways, right? The pessimistic outlook, and I almost fear putting this out there because there'll be a lot of shrugs, is the 2022 midterm elections are going to be the setup for the 2024 presidential elections. So we're not going to be leaving an election cycle, it's just going to be gearing up. And so if Republicans do capture the House and they come in with this view that they want to, build the narrative around 2024, sort of the pathways for bipartisan action on anything are kind of low. I think Biden would be open to some areas, things that could be done. Hydrogen potentially, mining reform could be done, but that's just if Republicans want to go down that direction and be open to actually passing bipartisan legislation, which they may not feel is in their best interest heading into 2024, where they could have a full sweep.
David Hostert, I want to come back to you with more of a European perspective on this. There is a lot of discussion over here about heating and what the European Union is going to do about gas use to heat homes over the next however many years. I mean, it's sort of a crisis mode. Are we going to move to heat pumps? I mean, my sense is all this stuff takes a long time. I would argue that home heating, cooling might be one of the most challenging areas to tackle. What do you make of it? And are there actual solutions that some of these transition technologies can play a role in?
Yeah, buildings are truly one of the kind of hard to abate sectors. Maybe the only one's more wicked is probably international aviation, but it's a challenging problem because if you think about kind of fleet owners for EVs, they're really thinking in total cost of ownership, right? It's all about this is what they're thinking about. They have a very good plan. For heat pumps, the upfront investment is significant on a household level, and it means that you then need to kind of reap the benefits of that over 7, 10, 15 years. And from a household perspective, that's very complicated. The challenge with heat pumps is they've been proven to work, the costs have come down, but there's an issue with the existing stock. In order for these heat pumps to work, you need to have proper insulation. You need to have, it's a lower heat, so you need to have different radiators. So there's some kind of substantial upgrades. And if you think about the UK building stock, for example, which is by and large very old, like a lot of Victorian row houses, this wouldn't work. You need to first put in cavity walls. That'll be a good start. So there's some real issues with uptake. Let alone the skills gap to actually have this on a broad level. So it is a hard thing to farm out. And the issue then becomes, and we've been talking about hydrogen and the hydrogen economy, there still needs to be a bit of a decision of what kind of hydrogen economy do we want. Is it going to be a hydrogen economy that's geared towards heavy trucking? That means we need to look at heavy trucking in this infrastructure. Is it going to be geared at households? That means we need to change the pipes in the last mile, make sure that the gas network can actually carry hydrogen, which is one of the most reactive elements of the planet, and then convert all those final appliances as well to run on hydrogen. So it's a bit of a strategic decision setting. From a European Union perspective, because gas supplies from Russia have dropped significantly this summer, we're now in a situation where some rationing might have to happen on a system level, but the last thing that you can do politically is to turn off heating in houses. So what's the most likely scenario, if there's going to be a shortage, is that there will be rationing on the industrial side through auctions, through kind of demand response on the industrial side. Converting housing stock is one of the big challenges. There's been some work we've done on heat pumps, on looking at demand, looking how it fits in, it features in our modeling. We have kind of great analysis on the total cost of ownership. But it is a very, very challenging thing. Somebody said when we started, like, energy efficiency is the quote unquote low hanging fruit. It really isn't.
Very interesting. I like that, and it is very contrarian. Okay, so David Deckelbaum, I want to come back to you. you've got a background that really spans a lot of things, including the traditional oil and gas business, and covering some of the service names, I believe, back in the day. And not to speak to any of them specifically, but I'm curious to get your thoughts on the energy transition, net zero, all of this discussion. Do you think that most of the incumbent businesses see this as a threat or an opportunity?
I'm sure that they see it as both. I think like what you're finding from, I still cover a number of exploration and production companies, and I think that what you're seeing in general is that, for one, every independent E&P company right now is just keeping production flat and focusing on returning capital to shareholders. I think a lot of politicians like to call that excess profits. I think it just happens to be that they don't control the price and they're not growing production. And that's what John discussed earlier, is this is a multi-decade cycle in which E&P companies were destroying a tremendous amount of capital. And this was an investor backlash that it was activist driven, ESG driven, that said, stop outspending cash flow by 180% every single year, right? So you've just seen more, I think, capital discipline. I think energy transition, I think there's still very much a recognition that like the U.S. probably needs to produce 12 million barrels a day for a very long time. And if you've lowered your break-even prices to $20 a barrel with several of the leading names out there, there's a pretty healthy margin between where we are today at roughly $100 a barrel, even considering the fact that you probably have a substantial war premium in there with what's going on, and your lower break-even. So I think it's just a matter of, I don't think that there's this existential threat that exists that says my terminal value of my company is zero. But I think for executives that are leading these companies, I think that they view it as an opportunity to say, hey, and this gets really back to the earlier conversation of, if fossil fuels have a role to play in the energy transition, right? I mean, there's humanity is at stake, right? So how do you produce efficiently? How do you do no harm? How do you limit your Scope 1 emissions? And I think you've seen all of those initiatives that are out there that actually create the opportunity, I think, for companies to differentiate in a world where they're all behaving exactly the same. Yeah.
Preaching to the choir. I mean, but the narrative seems to be so dominated by either the drill baby drill crowd, supply is the only solution, or we have to stop oil and gas immediately. And I don't know how we find the middle on this, at least on the political landscape. But John, maybe you can weigh in just on kind of, does that happy medium exist in your world? Can we actually find a policy that acknowledges the idea that for the foreseeable future, oil and gas molecules are going to be needed, and if they're not there, there's a lot of economic pain for all kinds of people around the world?
Yeah, the problem with that narrative is it doesn't spin into a great 30-second soundbite. Drill, baby, drill is something you remember, and getting off oil and gas yesterday is also something you remember. So there's these push-pulls on it, right, that are really, really challenging, and there's a lot of capture on the regulatory side and on the legislative side too, as well, as members have different constituents. So it's hard to see that emerging. Honestly, in the U.S., the closest pathway towards that would be the conversation around natural gas. I think that's just much clearer than oil for a couple of different reasons, right? There's been a successful argument is made that at the burner tip the emissions are significantly lower than the alternative, which would be coal, and that the technology exists really to make that upstream and midstream delivery as effective as possible. And to the industry's credit, some of the emerging exporters on the LNG side have really gotten ahead of that argument. They position their businesses as we can do emissions management, we can do carbon capture as we do the liquefaction, and we can also get really into the offset market. So hopefully that spins up and there are some net benefits to that. But it's difficult because the electorate can see climate change risk and damage, fires, storms, things of that nature. But it's much more challenging when it ends up being your backyard where a piece of infrastructure needs to be sited. And that's really the concern here. So both David D and I are in the sort of mid-Atlantic Northeast, right? And we're sitting on historic reserves of natural gas, right, that can't get to market. So that's pretty interesting. And the state of New York itself is really having difficulty getting heating for new homes, right, because they have a moratorium on pipelines, moratorium on fracking, moratorium on new hookups. So the policy we haven't had that forcing issue yet. California has kind of gotten the closest with its rolling blackouts and some storms in the past. Texas, had its example of that back in 2020, but the learnings so far seem to be pretty marginal, right? And again, I don't mean to be pessimistic about this, but one of the biggest issues with Texas was it's simply not interconnected to its neighboring states. Neighboring states had the same weather pattern. They had basically the same infrastructure and the same capacity portfolio, and they were able to lean on their neighbors, and Texas wasn't. Nothing's really changed on that. So, I don't know what the catalyst or forcing issue is, but I don't see it in the next 6-12 months.
Okay, thank you. Okay, so we are very much approaching the end of our time here. So I think an appropriate way to end might be to run down the line and put on get out your best crystal ball and look towards 2050. And in 2050, are we going to be at net zero? And if not, how close are we going to be? So David Hostert, I'm going to come to you first, and then we'll come back to our friends here at Cowen.
That's a tricky question because our modeling is designed to be at net zero 2050. The thing is, if you look at our economic transition scenario, which looks at what happens when your technologies play, you end up in a 3.3 degree world in terms of carbon emission. That's not good, and that's already assuming a rational system, which, as John just said, we don't have. So there's really strong action needed to get us there. I do think that technology can be this great arbiter of change, but there are issues in all of these different hard-to-abate sectors where policy really just has a role to play. So remember that wind, solar, battery work and getting cheaper. We need to get other technologies on that trajectory to really make an impact to net zero.
Okay, thank you. John, you're next.
I was hoping you were going to go to David first, and I could either be a bull or bear to his call. I don't see achieving 1.5. That doesn't seem likely in the current setup and the conversation around it. So one of the things that's interesting in that is what investments will be needed, what policies needed to make the system more resilient? How will agriculture change? How will industry change? And how will transportation change? I think those are the most interesting places. And we might also be in a place where we're not even looking at greenhouse gases as the primary concern in the atmosphere. There's all kinds of wild cards, right? So some of the more next or derivative thinkers in this space are talking about engineering the climate and things that can be done on that space. So there's so many variables there. I just see we're on this pathway of gradual integration of renewables based on cost and slowly on a policy rollout, and that seems to be the pathway forward.
Okay, thank you. Okay, David Deckelbaum, back to you. 2050, what does it look like?
Yeah, I like John's suggestion of relying on technology to just solve for climate management as opposed to trying to decarbonize. But look, we have 28 years, and I think that if you look at the amount of CO2 that you would need to decarbonize, and let's say that's on the order of almost 60 million tons per year, I think that there's visibility to at least doing half that, and I think that there's the remaining 50% is going to have to be policy driven, because that's when you get into efficiency and fuel switching, and I think it just is a matter of how long do you continue to push the same initiatives globally. But I think humanity certainly has a chance of getting there, but you also certainly are going to be reliant on technologies and the CCS industry by and large to scale fairly rapidly in the coming years, and that includes point source capture, it includes carbon removals, it includes things like direct air capture. So I think that there are solutions there, but it is threading a needle that's quite difficult.
Okay, well, that's great. I'm sharing my screen again just so we can put the contact info for everyone who's been on the call. If you don't know how to get in touch with us, the emails are there. I'm happy to say that both John and David are terminal customers, so you can shoot them an IB after the conversation if you want to follow up with them individually. And last but not least, I'll just say that this has been fun, and we're going to have another discussion next Thursday at the same time. We're going to go deep on hydrogen for that one with some of the team at Cowen. So make sure to join us for that as well. I hope everyone has a great afternoon. And if you're ever in London, reach out and say hello. It'd be great to see you in person. Take care.